All right, I think we're ready to start. Welcome those of you who are here with us in person, as well as those watching on webcast. I should say that this is the only room we have for this kind of an event. We have very small conference rooms, and we have this big room, which we're setting up obviously for the MRAC meeting tomorrow. But we wanted to be able to show you the slides and do a webcast, so that's why we're here. So we're here today to present a report that the staff has been working on for quite some time, conducting a supervisory stress test of clearinghouses. And the purpose of this exercise was to look at the resiliency of 5 major clearinghouses under our jurisdiction. These are clearinghouses in the US and in the UK. And we're looking at that under a variety of stressed market conditions in order to assess the impact of those conditions using actual data on positions and margin data that we get routinely. So we're looking at the overall risk also that the largest clearing members pose across several asset classes and across these clearinghouses, and looking at the sufficiency of the pre-funded resources that the clearinghouses have. Now, I want to spend a few minutes just on the background, just to make sure we're kind of all on the same page as to the resources that we're testing here and the focus of these tests. So I think, as many of you know, central clearing has been used in the futures market for quite a long time, about 100 years. And really, the combination of central clearing as well as exchange trading propelled the growth of the futures market in our country, so that they did become the largest in the world. We expanded the use of central clearing under Dodd-Frank. We mandated clearing for standardized swaps, and therefore the volume has increased significantly. This shows you that increase. You can see in June 2008, the margin, which is a good proxy for level of activity and level of exposure, if you will, 90 billion in 2008, about 300 billion today, equally divided today between swaps and futures. Why did we expand clearing? Well, we saw in the crisis that bilateral transactions were opaque. We had no information on the exposures of large institutions. We could not see risk across members, and therefore a default between 2 large institutions could easily cascade into multiple defaults, sort of a domino effect. That was the concern with Lehman, with AIG, and so forth. The futures market, by contrast, worked well during the crisis. The markets worked, clearing worked, and there really weren't significant issues. So we decided, the G20 leaders committed to using centralized clearing for swaps, and the goal was to improve risk mitigation and monitoring, and we'll talk about how CCPs do that. Again, a comparison of uncleared and cleared markets. The uncleared, essentially when you have all these bilateral transactions, it starts to become a tangled web, or sort of looks like spaghetti or something. Whereas with the clearinghouse steps in between every trade. It's the buyer to every seller, the seller to every buyer. It doesn't create market risk itself because it has a balanced book at all times. What we mean by that is, if there is a trade where someone is short crude oil futures, there is someone else who is long. And the clearing members here have the relationships with the customers. They clear the trades, and clearing members, of course, are affiliates often of the very same institutions that you saw in the uncleared marketplace engaging in the bilateral transactions. So clearing members are essential to the proper functioning of a clearinghouse. But the CCP, the clearinghouse itself, is an independent party that can monitor and mitigate that risk by requiring margin and having rules for clearing members and so forth. Nevertheless, people have said, well, have we just moved the risk? Haven't we just created these new concentrations of systemic risk, these new points of failure in the system that are going to be a problem the next time we have stressful market conditions? Let me just give you my general answer, and then obviously the results of this test, I think, bear on that as well. My general answer is, yes, transaction risk still exists, but it is easier to monitor and mitigate with the CCP. It's less likely to lead to a destructive chain of defaults. And that's because clearinghouses have tools that we're going to get to in a moment, such as requiring margin, requiring capital, and ongoing risk surveillance. Clearinghouses must meet international standards. They have tools to manage default that we'll talk about. So I think the answer to the question is, as long as we're vigilant and as long as we ensure that clearinghouses are resilient, then I don't think they represent that new point of failure, if you will. So what are those tools? Well, key ones are variation margin and initial margin. Each day, the clearinghouse determines a settlement price for each product. That represents the current market value of the trade. So, when you first enter a trade, you first go long an oil future. Again, there's somebody else who is short on the other side, but there should not be a greater value for one party or the other. Once the market starts to move, there can be. Someone might have a loss, someone else might have a gain. The clearinghouse collects each day from those who have a loss based on that market movement, pays out to those who have a gain, again, because it has a matched book. So the collections equal the gains. And so because it does this on a daily basis, that prevents any trader from accumulating losses for more than one day. The clearinghouse does it vis-a-vis the clearing members. The clearing members then do it vis-a-vis the customers. Initial margin is collected as well. That's essentially like a performance bond for the potential future losses collected up front at the start of the trade. Now, there's lots of other requirements and tools. The CCPs have clearing member requirements, capital requirements, and other requirements on how the clearing members conduct themselves. And as I said, they engage in risk surveillance. We engage in risk surveillance. I'm not going to go into all that today other than to just briefly note, and this is discussed in the report, the elements of our risk surveillance program. We get a lot of data on clearing members and their customers. So we look at actual positions. And to the extent we see something that concerns us, we can engage in communication with the clearinghouse, the clearing members, and the customers. All right, but what if a clearing member does have a problem? Well, then there are resources. The first, of course, is that defaulting member's initial margin. And that's because the basic principle, there are two basic principles in how a clearinghouse deals with a default. The first one is the defaulter pays first, and the second one is loss mutualization. The defaulter pays means the party who introduces the risk to the clearinghouse should be responsible for paying for that risk. So we use that initial margin first. But if that is not sufficient, then we have clearinghouse capital and we have the Guaranty Fund. The Guaranty Fund represents a mutualized resource for the benefit of the entire market. It is pre-funded by all the clearing members. It sits with the clearinghouse today, as does that margin, both variation margin and the initial margin. And those funds are invested only in permitted investments. In fact, today we're working with the Federal Reserve so that clearinghouses can deposit cash with the Federal Reserve. That Guaranty Fund is sized to meet what we call the Cover 2 standard. The standard that says if we have a default by the largest two clearing members, the two clearing members with the largest exposures under any scenario, that Guaranty Fund has to be sufficient to cover those losses. Now, there are other resources that a clearinghouse has, assessments on members, and other tools, but what we're focused on are those pre-funded resources. Now, let me underscore, no clearinghouse in the United States has ever had to tap its Guaranty Fund. And likewise, the other tools that we list here have never been used. But our test focuses on what would happen in these extremely stressful scenarios to look at the adequacy of those resources. In a default, the clearinghouse is trying to allocate losses and then restore a matched book and maintain the continuity of functions. All right, so a word on stress testing. Clearinghouses do stress testing all the time. It's required by our rules. They must do it daily. We do it also, and again, it's used to look at the adequacy of margin methodologies and look at the sizing of the guarantee fund. And it's done using what we call extreme but plausible scenarios. Supervisory stress testing is what we're talking about today. That's a little different. That is looking across clearinghouses, looking at multiple clearinghouses, again, using extreme but plausible scenarios so that we analyze the consequences across CCPs and with respect to the clearing members themselves. So, the objectives of this stress testing exercise were to assess the impact of these stressed market conditions across multiple clearinghouses using actual positions and actual financial resources, analyze the overall risk that the largest clearing members pose across all these asset classes and clearinghouses, and evaluate the sufficiency of the pre-funded resources. Again, initial margin, capital, guarantee fund. The tests don't address certain other risks that CCPs face, and we're equally attentive to those, but they're not the subject of this test, such as liquidity risk, operational risk, cyber risk. Let me turn now to the methodology of the tests. First, the clearinghouse is covered. I said there were 5. This is the list. CME, 3 ICE entities that clear different types of products, and LCH. These are the largest clearinghouses in our markets. They are all registered with us, and that's why we have this wealth of data on actual positions and margins. Now, each clearinghouse has a guarantee fund, and it may have multiple guarantee funds. These 5 clearinghouses have 5 guarantee funds. Why are there multiple guarantee funds? Well, again, there are multiple asset classes. Think of it like the following. If you have a car, but you don't have a house, you're going to have car insurance, you're not going to have house insurance. Car insurance means you're in this risk pool for everybody else that has a car. But why would you be in the house insurance pool? You don't have that risk. So if you're a clearing member that participates in futures, but not in swaps, you would be in the futures guarantee fund, but not the swaps guarantee fund. There are 8 guarantee funds across these clearinghouses. Here's a picture of the guarantee fund amounts as of March 31st. Our actual date of applying the test was April 29. The guarantee fund amounts are adjusted quarterly. We did test both those dates to make sure they were representative. Here's a picture of the Clearinghouses Own Resources, the capital. Now, sometimes people look at it and say, well, that's not very much capital because they're thinking of banks. It's important to remember that clearinghouses are not banks. The market risk of a clearinghouse comes from the clearing members. That's why we have the principle of defaulter pays first and then loss mutualization. Otherwise, the firms that are bringing the risk to the clearinghouse would not be incurring the cost. Products covered in the test. We looked at the most widely held contracts at all of these clearinghouses, and there's a list of them in the report. It's about 40 different contracts. It covers all asset classes, both in futures and in swaps. All right, what about the clearing members? Which clearing members are included? We included the 15 largest clearing members at each clearinghouse. By largest, I mean those that had posted the largest amounts of margin. Now, the 15 in one clearinghouse may not necessarily be the same 15 in another clearinghouse, although there is a lot of overlap. So when we looked at the 15 in each, we wanted to get a consistent group across the 5. That gave us a total of 23. Those 23 groups account for 88% of the total initial margin required by these 5 clearinghouses. So it is the vast majority of the activity. The 23 groups often have different affiliates at different clearinghouses. We combine those. They also have customer accounts and house or proprietary accounts. Those are separate. So there are separate accounts. And these 23 groups across the 5 clearinghouses, there's a total of what we call 23 house accounts and 20 customer accounts. That results in a total of 43 clearing member accounts, a number that we'll come back to. Okay, so here's another picture of the size of the cleared markets today. Again, remembering 300 billion in total margin. You can see the blue represents the customer amounts. Is that working? I'm not sure that's working. And the red is the house. So it's about 200 billion in customer and 100 billion in house. House funds can be used by the clearinghouse to offset losses on customer positions. But customer funds cannot be used to offset losses on house. We apply that principle in the tests. All right, so what were these extreme but plausible scenarios? I refer to them as hypothetical, but they were based on a lot of historical analysis. We looked at over 20 years of data. And we looked at our own catalog of stress tests. We looked at the stress levels used by the clearinghouses. We looked at what the European authorities did in their work on this. And here's an example. There's 3 contracts shown here. There's about 40 total. All right, so let's take gold. So the gold futures contract. What this shows you, let's go to this middle column first. What was the highest actual historical movement, meaning one-day movement in price? It was 9% on September 17, 2008. You might recognize that date as being right after the Lehman failure. Okay, so we used, for our highest movement up, we used 10%. And the same for these other products and all the products. You can look at this in the appendix. Now, you might notice here on the S&P 500, this is S&P 500 futures. You see the lowest actual historical return was 28.6% in 1987. And you say, well, wait a minute. You're only using 20% here. Why aren't you using 29 or 30? And that's because after 1987, all the exchanges, both in the cash market and the derivatives market, put in circuit breakers and limits, so we don't see this kind of one-day price movement anymore. So instead, we still use something pretty high. In fact, the input we got from clearinghouses in some cases was our stress up and stress down levels was too high, but we decided to stick with it. All right, so here's another example of what we use compared to some recent historical dates. You've got the date here of the Lehman collapse. October 13th was the date when the initial TARP investments were announced in the major banks, as well as a variety of other actions around the world to deal with the crisis. October 21st, the market actually went way back down because of various developments related to the crisis. And here's the day after Brexit. So you again can see for each of these 3 contracts how the historical amounts compared. Red is a movement down, black is a movement up, how that compared with what we used. And you will see that our amounts exceeded significantly, in most cases, the actual movements. All right, then we looked at what we call the correlations. So for all those 40 or so contracts, you can group them by asset class, right? If you have gold and silver, you group that in metals and so forth. So we looked by sector, and we said, all right, if interest rates go down, for example, interest rate futures would go up. What happens to equities? What happens to gold? And of course, you see different correlations in different dates. Again, we looked at over 20 years worth of data and came up with a variety of scenarios, each based on a historical precedent. So here, scenario 4 shows you the basic correlations we used. So if we say down, then it would be down by that highest stress level we showed you earlier, and up, it would be up by that amount we showed you earlier. All the data, by the way, is anonymized in this report because we're required to do that. We have to protect confidential information. And so sometimes we'll refer to scenario 4, later we will refer to scenario A. We've done sort of a few things like that so that no one can try to reverse engineer it. So here are the various scenarios we came up with. We came up with 11, and you can see the different correlations. All right, so how did we apply the methodology? We began this process in the spring, and this was all done by the staff with the data that we get from clearinghouses and clearing members and customers. We chose April 29th as the as-of date. Again, we verified that date would be representative. We reviewed the test results and the methodology with the clearinghouses as well as with other regulators. And we applied these movements, these price movements, as instantaneous shocks. And the reason for that, again, is because the clearinghouse calls for margin every day. If there is a price movement, clearinghouse then calls for the margin so that losses do not build up. Now, then we made a very extreme assumption. We said, let's assume every single firm of the 23 firms, if they have a loss that exceeds margin, let's assume they do not make any additional payment to the clearinghouse. Now, I say that's extreme because we've never seen a situation like that. In Brexit, for example, the day after Brexit, we had extreme volatility. There were firms that had to pay billions of dollars, up to $3.5 billion in margin for that day, compared to normal payments they would make of, say, a few hundred million. Every single firm in Brexit made those payments. We're assuming no firm makes any payment under any scenario. Okay, so let's go to the results. First is, did the clearinghouses individually meet the required resilience? And again, the purpose of our test was to look across clearinghouses and across clearing members, but a building block of that is really looking at each clearinghouse individually. So, as you saw, we had 11 scenarios across the 5 clearinghouses or 8 guarantee funds. Now, you could sort of do the math and say, well, hey, that's 11 scenarios across 8 guarantee funds, so it's 88 different scenarios. It's actually less than that because some scenarios produce identical effects on a guarantee fund, given that the guarantee fund is only for certain products. Remember that some guarantee funds are only for futures, some are only for IRS, some are only for CDS. So certain of our scenarios will essentially produce the same effects. But you still have essentially 36 non-duplicative tests if you look at it across those 8 guarantee funds. So what happened? The clearinghouses achieved cover 2, in other words, the required resiliency standard in every single instance, 100%. And we found that these pre-funded resources allowed them to exceed that cover 2 standard. Again, cover 3 means you've covered the losses, the 3 largest losses. Cover 4 and so on. Cover all would mean every single firm that had a loss was covered. That was almost 2/3 of the time. Again, keeping in mind, this assumes no single clearing member provided any additional funds to the clearinghouse after we applied these stressful scenarios. And remember also, given the nature of the clearinghouse model, you cannot have a scenario in which all the clearing members have a loss because the clearinghouse has a matched book. Okay, then we look at whether clearing members have similar risk profiles. In other words, did the same scenarios cause shortfalls at multiple clearing members? And what we found was generally no. There were 43 clearing member accounts. As I said, the 23 corporate firms had 23 house accounts, 20 customer accounts. if you look at what scenario accounted for the worst outcome for each of those accounts, was it the same scenario? Actually, not really. The same scenario only accounted for the worst result at 8 of the accounts, 8 out of 43, or about 19%. 10 of the 11 scenarios generated the worst outcome for at least one account. So what that illustrates is that these clearing members, as of this date, looking at actual positions, had diversified risk profiles. A lack of diversity, of course, would be shown if the same scenario caused the worst shortfalls for a very high percentage instead of the 19% that we see here. You can look at diversification in another way, which is, well, look at the diversification from the perspective of the 36 tests. Many people will assume that if one clearing member has trouble, all of them will. And this found, again, quite a bit of diversification. No single clearing member had the largest loss in more than 6 of the 36 tests, and no 2 firms generated the largest losses at more than one guarantee fund in any scenario. So in other words, looking at our 11 scenarios, and you say, let's look at who had the largest losses. What are the 2 firms? Those 2 firms were not the same at more than one guarantee fund. All right, so then you can look at the following question. If a clearing member has a big shortfall at one clearinghouse, did it incur shortfalls at all the clearinghouses or all the guarantee funds? By shortfall, what we mean, again, is the scenario we've applied has created a loss in its positions that exceeds the margin that's posted. That is what we mean by a shortfall. If, in fact, the scenario that's applied results in, after you apply the margin, that there is still excess margin, that would be what we call a remainder. And of course, the scenario may actually produce a gain for the clearing member that we view as sort of positive also. So again, a shortfall means your margin isn't sufficient to cover the loss. A remainder or a positive result means either your margin was more than sufficient or you actually had a gain. So if you had a loss at one clearinghouse or one guarantee fund, what happened at the others? So what we did is we looked at each clearing member account and we calculated what was their worst net shortfall across all these clearinghouses. Again, we're applying the same scenario, same date to actual positions. And here's the total. Now, in the report itself, you'll see a list of 43 accounts. We've just pulled out a couple as examples here. We first pulled the 2 accounts that had the worst net shortfall across all clearinghouses under any scenario. But what you see is, for example, this first one, they had a loss at what we're calling Guarantee Fund 1 and Guarantee Fund 3 and Guarantee Fund 7, but they actually had a remainder at 2 guarantee funds. That's the plus sign. Same thing for the next one. They had a shortfall at 4 guarantee funds and a remainder at 4. Some firms never had a shortfall. In all the scenarios, all the tests, there are some firms that always had a remainder. But even if they had a remainder, they might have a shortfall at 1 guarantee fund. So that really goes to this question that people have asked. Well, now that we've moved all this risk into clearinghouses, boy, if somebody defaults at 1, that's really going to trigger this cascade the same way it did in the old days. And that same clearing member is going to be defaulting all over the place, and that's going to bring down all these clearinghouses. Well, again, I think these results show that the clearing member risk is highly diversified by scenario across clearinghouses and guarantee funds, as well as the fact that the clearinghouses have adequate pre-funded resources to meet and exceed, actually, the required resiliency levels. So, conclusions. Clearinghouses had the financial resources to withstand extreme market price changes across a wide range of products. Cover 2 requirement was met in every single test, and in 64% of the tests, again, 64% of the unique scenarios, there was sufficient coverage to cover a default by every single clearing member, assuming, again, no clearing member posts any additional margin. We also saw that a clearing member with the worst loss or shortfall in any particular scenario at one clearinghouse did not have losses everywhere. In many cases, it had a remainder or a net surplus, even a net gain, remaining or across all clearinghouses. The clearing member positions were highly diversified across clearinghouses. You could look at that by scenario. You could look at that by which two clearing members would have the worst shortfall in any situation. And again, we found that 65% of the accounts did not have a margin shortfall under any scenario. Okay. No single scenario produced the worst result for more than 8 of the 43 clearing member accounts. And the identity of the two firms generating the largest losses was quite diversified. There are other ways to look at these issues, at the diversity issues, and they're explained in the report. Now, this is a test only as of one day. It's quite a few scenarios, but it's still a limited number of scenarios. It only looks at price movements over one day, even though that is, I think, a key, very important way to do it for a clearinghouse. One could construct a test that was over a longer period. It's also, as I said at the outset, it's not a test of liquidity, investment losses, operational risks. There are other risks that clearinghouses face. But nevertheless, we think this is an extremely important result. We intend to conduct these tests on a regular basis. The program will be continually enhanced. There's a lot of potential enhancements. Some of them are listed here. They're discussed in full in the report. As I said, we could expand the scenarios. We can look at a longer period of testing. We'll probably engage in this kind of work with other regulators. We have been in touch with other regulators on this report and on this idea or on these tests. There's also a lot of work going on in the international community to develop further standards for stress testing, and obviously we will incorporate that into our future work. I want to end by thanking our project team. This was an enormous amount of work. We did this all in-house. As I said, we started back in the spring. And some of them are here today. Jeff Banman, who's our acting director of Clearing and Risk. Why don't you guys stand as I said. Jeff is here. John Lawton, our deputy director, is here. Steve Greska, Jim Marcello, and Glenn Schmeltz are also here with us from our Chicago office. So there are others on the team, but it's really a terrific product. And with that, I'll be happy to take your questions. Yeah, Patrick. Is it on? Just turn it on.
Hello.
Yeah,
okay.
There you go.
Hi, Chairman. Thanks for your time. Was there anything in here that surprised you particularly, knowing going into the stress test about how it would what the questions would be and how things would go? Was there anything that you were like, gosh,
well,
this?
Yeah, I mean, I think generally it was all good surprises. I think the degree of coverage, the fact that in 2/3 of the tests, the pre-funded resources were sufficient to cover all losses without any further posting of margin. That was a surprise. And I think that's probably the main one. The degree of diversification, too, I think was a pleasant surprise. Yeah. Yeah.
Okay.
Yeah.
Okay. It seems like a very good report card. Was there anything to come out of it that was still worrisome or an area where you think there needs to be more protection?
Yeah, that's a good question. I think I would answer that question the following way. This is a test as of one day with limitations. We're not taking any victory laps over this. The key to clearinghouse resilience and strength is ongoing vigilance. There's a lot of other work going on that we are engaged in to make sure clearinghouses are safe. A lot of work going on with domestic and international regulators. Constant risk surveillance by both the clearinghouse and us is critical. And as I say, there's other categories of risks that we aren't even testing here. So while we're pleased with the results, this is no reason to lessen all the things that we're doing. Yeah, Andrew. Try it again.
Can you talk about the broader context for these tests and why you're doing this now? And is there skepticism from other regulators that there aren't ample resources at these?
I think there's a natural concern. To me, this is part of really evaluating the effects of the reforms we've undertaken. And I think that makes absolute sense that we should do that. We've made clearinghouses more important in the global financial system. And we have taken a lot of steps to enhance their resiliency. We did an overhaul of our rules. We strengthened customer protection. We strengthened the oversight of clearing members. We expanded our examination and risk surveillance programs, but I think all that makes sense, and I think we got to continue to do it to make sure that these reforms are working. As to the timing, this is something that we've wanted to do. As I said, it's a pretty intensive effort, so it took some time to complete it, but we intend to continue doing this. And also, as I noted, there is a lot of discussion going on in the international community on this very subject. We're not aware of anyone else having really looked at it the same way we are. ESMA has done some very good tests, and we're in touch with them on theirs and sharing our results. But there's a lot of work going on developing standards for supervisory stress tests. There's a project that the Financial Stability Board has on looking at interdependencies. Interdependencies essentially means, given that we've got clearing members that are significant at more than one clearinghouse, what kind of risk does that pose? Well, this addresses that issue. It's not complete. There needs to be more work on these things, but it's a way of looking at that question. Can we get questions off the webcast or no? Okay. Any other questions in the room? Yes, please.
But obviously, with the election results, there are a lot of questions of
Sure.
what happened to a lot of pending things, and you've laid out a pretty ambitious agenda of rules to get through. Could you comment on how that might affect that agenda? I'm particularly interested in the position limits rule and whether you'll still try to push that out.
Sure. Happy to do that. Well, first of all, let me say that I am committed to a smooth transition at the CFTC, a smooth and orderly transition. I've had conversations with both my commissioners about that. My staff has had conversations with their staffs. We've also been in touch with the transition team. And so we'll continue to work together to make a smooth transition. I think that's incredibly important. At the same time, we'll continue with the work of the agency. I think it's important to do that. And I've articulated what my agenda was for some time. and I'll continue to work on that. With respect to position limits, the rule is before the commissioners for their consideration. I look forward to their input. I've always tried to build consensus on everything I've done, and I'll continue to do that. Anything else? Yeah. Yeah, the total IM of what we studied was 88% of the IM held by these 5 clearinghouses on that day. Okay, if there's nothing else, obviously for anyone watching on the webcast, members of the media, if you have questions, just please call us. We're happy to answer them. Thank you. And copies of all these materials will be or already are on our website.